Well, hello and welcome everyone. Happy Friday. It is September 9th, and I'm very excited to be with you all today for our Right Capital presentation on tips and tricks for analyzing Right Capital's student loan module. Now, this is a really informative presentation because, of course, here at Right Capital, we have, one of the only, financial planning software's student loan analysis tools, which is really helpful at this exact moment in time, as there's a whole lot of new information out there available around, student loans and different planning opportunities that might be available to your clients. Now, this is a really great module within Right Capital, and we really feel that it was important to include in a planning software, as many people these days are burdened with student loan debt. And we all know that, with a lot of recent legislative changes taking place, there's a lot of focus on this topic within the industry. So we feel overall, this is a great way to engage new customers or existing customers, or assist even with, the family of customers you already work with. It's ultimately a great way to leverage yet another tool in Right Capital to use for fee for service planning, or even just within a holistic financial approach. But we are here to talk all about Right Capital student loan module. And what that means is we are here to talk about student loans in the US. And of course, there are a lot of them. Even after this recent round of forgiveness that was provided by President Biden. So there's a good chance that if you're working with younger clients, if you're building, that book, if you're, setting up some maybe fee for planning services, that you might encounter individuals who are attempting to create a situation where they can both pay their loans down effectively and manage their finances moving forward. Or you may be working with people who are facing, very important decisions in life. Maybe someone who's just graduated medical school, who's looking to potentially work for a not-for-profit hospital that may pay a little less, which may create some eligibility for public service loan forgiveness, versus somebody who's working for a private sector hospital who might get paid a little more upfront, but not benefit from those loan forgiveness programs. So we can really use Right Capital to compare and contrast these different options for the clients and understand what might be the best for them. But in order to really get into this effectively today, we're going to have to first take a moment to talk a little bit about student loans in general. For those of you who caught the recent presentation, the CFPCE presentation on student loans, you'll be familiar with what we're talking about. But for those of you who haven't seen that one, there's recordings in the help center, but we'll talk through some of the planning opportunities that are associated with specific loans. And ultimately, we know that there's both different types of loans out there, both federal and private institutional loans. There's also different types of repayment plans, whether it's a standard repayment plan, a graduated repayment plan, or one of the income-driven repayment plans. And so we know there's some background information we want to help you contextualize there, but we also want to help you understand within Right Capital, what are the important settings and assumptions that you should be aware of when dealing with student loan planning, and how can you go about helping clients to see different planning opportunities that might be in front of them, and model, let's say, a case study to help them see the benefits that you can provide to them with your planning services. So our goal is to kind of take this from start to finish. I have roughly around 35 minutes of content here for us, and so we'll dive in here momentarily. But the first thing I want to do is just, again, provide a little bit of context on which different loan types you might be encountering out there in the industry, because many times there's not a whole lot of data that the clients know about to figure out what exactly the loan type they're in or what repayment plan they're using. So we really want to break this down into two kind of very large categories: federal loans and private loans. Now, federal loans in general will have the most financial planning opportunities associated with them, because of course they will be eligible for things like income-driven repayment plans, which can help lower monthly payments and offer loan forgiveness by themselves. The federal loans are also potentially eligible for public service loan forgiveness, and there's a difference between just, income-driven repayment forgiveness and public service loan forgiveness that we'll talk about. And certainly, though, not all loans are created equally. So we know, for example, those private loans, those institutional loans, there might be opportunities for things like refinancing those to pay them off quicker, and we can certainly show that. But in terms of working towards, the different income-driven repayment plans and public service loan forgiveness opportunities, there'll be a little less of that built in, for in terms of opportunity, unless federal loans are taken out in the future. So these are just the general types of loans you might see. Federal direct are going to be the most flexible with the most opportunities for you. The older, Perkins loans or federal family educations loans, these are all, good loans to have, but they are not going to have quite as many opportunities for income-driven repayment plans. And also they won't have opportunity for public service loan forgiveness or PSLF, unless, of course, they are consolidated into a direct loan. So it's important, there's context here. So knowing what kind of loans your clients have can really help you to understand what opportunities they might see in the future for financial planning. And of course, I want to mention that all of these visuals, all of the data I'm covering in this PowerPoint are available in the Help Center. So you can always find that data in RightCapital's Help Center by just typing in student loans, and you'll find some good resources that are available to you. Now, beyond, of course, the student loan types, I also just want to quickly mention that the most common income-driven repayment plans that we see in the industry are IBR or income-based repayment, pay as you earn or payee, which is another income-driven repayment plan, and revised pay as you earn or repayee. And these types of repayment plans are contrary to the normal standard 10-year repayment plan, which of course just pays off the loan within 10 years of the client's starting to pay. But these payment plans are actually based on the client's income. So they can help for individuals who are maybe just getting out of school, maybe working in their clinicals or in their residencies where they're not getting paid the full amount that they will be in the future, for those medical school students or others. And ultimately, we might see that there could be opportunity to take advantage of lowering payments today based on the income, and then having potential loan forgiveness after you reach the loan term, which is terms 2025 based on the different repayment plan. And what's interesting about these is they're all based on a percent of the client's discretionary income. And so when we talk about things like, for example, a IBR plan, it's going to be, the payment itself is going to be based on what the client is making today. And that's something that's going to be, factoring in the state's poverty guidelines. It's essentially, the client's, or I should say the client's resident state's poverty guidelines, 150% minus their AGI. And so that's going to give us our discretionary income, and we see 10% of that. But ultimately, RightCapital builds all of those data points in for you. So you don't have to worry about going through all the calculations. We're going to calculate all these payments automatically based on the client's income, future income, and resident state. So that's a bonus. We're also going to calculate the loan forgiveness at the end of these terms, whether it's taxable or not, based on the timing. So it's all very helpful for us. And beyond that, we want to mention that each of these different repayment plans may have some different planning opportunities. Some may be eligible for lowering payments if you can use married filing separately, for example, like IBR or payee. Others have different payment amounts or payment caps. And so again, what's nice is, these payment plans sometimes with IBR and payee don't allow you to pay more than the standard 10-year payment amount, meaning you can never pay these loans off faster than you would if it's an income-driven repayment plan, as you would have with a standard 10-year repayment. So there's some different nuances here that are incorporated, and the reason I'm showing these slides is because when we look, for example, at an income-based repayment plan, there is a payment cap, for example, and that payment cap is the actual standard 10-year payment amount. So when we're actually entering data into RightCapital, there's going to be certain areas that are going to be important for us to fill out, like, for example, maybe the standard 10-year payment amount, even if we're not using a standard repayment plan. And the reason it's going to be important to fill that out is, of course, because maybe the payments will be capped at that amount with an IBR repayment or a pay-as-you-earn repayment. So that becomes important data to be aware of as you're, building in, the inputs for the financial plan and eventually leveraging something like our student loan analysis. So what I'm going to do is just kind of transition over to RightCapital. I want to introduce you to a case study, and we're just going to talk through entering the student loans. We're going to look at how to use the student loan module, and then we'll look at how to go about entering that data, let's say, into the retirement analysis and comparing two situations between maybe somebody working towards public service loan forgiveness versus not. So all of this, again, is important for us to be able to kind of conceptualize, but let's have some fun now. Let's dive into RightCapital. And just as a reminder, we are here to help and answer questions. So if you do have any questions today, you are welcome to use the live chat feature, or I should say the live questions feature here within GoToWebinar. There's a questions drop-down menu in the control panel, and that is where you can type in anything you have for me in terms of questions. Now, as I load up my RightCapital login, I also just want to remind you all that there's, really great resources out there for student loans within our help center here. And so if you're within our help center, you type in student loans, you're going to see, a variety of different video overviews or knowledge-based articles, or even articles on data entry or how to use the student loan module. But we also will give you links to areas like this, the studentaid.gov website. Which has lots of great information, right? New announcements on, the extended, student loan payment pause, for example, or different loan calculators or different information on these different income-driven repayment plans, especially maybe the new one that's been being introduced by Biden currently. So that's really helpful. But today, again, what we're going to do is take a look at a specific plan where we have Bruce and Robin. And these are going to be our case studies for today when we analyze, this student loan analysis. So just to give everyone a quick overview, we have, some younger accumulators here, Bruce and Robin, in their mid to late 30s. They have a young child. We can see that this household is one that, makes around $220,000 annually. Maybe Robin's just graduated from, medical school. She's, kind of working through her options currently. And we are looking at this particular plan as it relates to, of course, how this couple can effectively manage their loans over time. So as we visit the net worth, the loans that we'll see in this plan, of course, are going to be entered here, or step 4 of the initial data entry. And as we click Add Account Loan, we're going to see an option to enter something like, for example, a student loan. And by entering this student loan, we're actually going to activate the dashboard student loan module. Before I hit save here, you'll notice that if I visit the student loan module, it's going to be turned off. So it's going to say you don't have any student loans, please input them in the net worth page. But as I actually visit that loan, as I input the data and hit save, that module will be activated. So let's just talk about this. Maybe this is Robin's medical school loan. So if I type in, Robin's medical school loans, I can lock this information in place. I can, type this in. Maybe this is her Nelnet loan or her, one of the many loan servicers that are registered with the federal loans. But again, we could see it, or we could link that in through account aggregation as needed. But as I indicate student loan, there's some really important fields, everyone, that will make a big difference on our student loan module. Number 1, the student loan type. So you may have remembered that graph earlier we saw in the PowerPoint. Well, based on the loan type, whether it's a direct federal loan, an FFEL loan, an older Perkins loan, or a private loan, we're going to be seeing very different planning opportunities. And I'm going to start with a direct loan because this is a loan that's going to have, again, the most opportunities for us in terms of financial planning scenarios that we can outline. But obviously the loan type is actually going to be analyzed by RightCapital, and you'll be able to see what options are going to be potentially available for the client based on that. And we'll just give you that information when we access the student loan module. We also want to know, is this loan for undergraduate or graduate? That's going to help us determine what income-driven repayment plans we're eligible for. And we also want to know what payment plan are we using? Is it a standard 10-year repayment plan, a income-driven IBR plan, pay-as-you-earn plan, or revised pay-as-you-earn plan? So let's just say I'm using the standard 10-year payment currently. But note that if we are using things like an income-based repayment plan, the actual payment start year will be important because there's actually different breakdowns of the actual payments, whether it's 10 or 15% of the discretionary income based on the start date. So just know that start date is going to be important for us. So when did these, when did this client, take out the loans, for example? What's the loan interest rate? Also very important. The balance, maybe there's 200,000 on these medical school loans, and the current payment. So maybe they're in that standard repayment plan. Let's say they're making $2,200 a month payments on this particular loan. And importantly, again, I want to re-enter this standard 10-year amount here, because if I switch to an income-based repayment plan, those are going to be capped at the standard 10-year payment amount, meaning they can't be any greater than that amount. So if I accidentally leave this at 0 and I switch to an income-based repayment plan, for example, the payment might actually be capped or limited to the amount that's shown in this field. So just be aware of that. And if you're ever looking for what the standard 10-year payment might be, again, studentaid.gov has some great calculators you can leverage to show that detail. So let's just say I save this information in place. We of course can see not only that this $200,000 is a negative value that's reducing the net worth, and will of course be paying that over time within the cash flows. But I can now visit the dashboard tab to access the student loan module. This is where we're going to see all that data around what's going to be happening for this individual client as we're working through the data points. Now, a really good question here I just want to leverage here from one of the advisors. My understanding is that it is up to the client to determine what kind of repayment plan they want. Is that right? Or can I advise them on which repayment plans to do? So that's a really great question. Thank you for teaming me up for that next conversation. When we actually set the client up with when a client is set up with a loan, 9 times out of 10, they're just going to be set up with the standard 10-year repayment, or maybe a graduated repayment that still pays that loan off in that timeline, but just might scale the payments up and have a little more interest. But overall, we can see that when we actually look at this loans tab of the student loan analysis tool, we're going to be able to see the loan type for the client, and then we'll see what income driven repayment plans that specific loan will be eligible for. So what this is telling me is that Robin's loans are eligible for income-based repayment plan or revised pay-as-you-earn payment plan, not pay-as-you-earn, and they would be eligible for public service loan forgiveness after consolidation, and they are as well available for options for private refinancing if they maybe want to pay those loans off faster. But for clients who are struggling to meet their payments, they will have a few different options with the income-driven repayment plans. Some require partial financial hardship. Others potentially will require the clients be in certain types of loans. So again, just keep in mind that the federal versus private loans and the client's unique situation, whether they're married filing joint or whether they're a single filer, will likely guide what type of repayment plan they will elect for and what opportunities might be available. But again, most times you're dealing with an individual who is just provided that standard 10-year repayment to start. So anyway, I digress, but here we are in this student loan module within RightCapital. As always, we're just going to start by showing, what this looks like for the client with, payments over time. We can see, we haven't made any proposals yet, so the current and proposed payments are the same. We can see, the loan balance, slowly paying down over, those, 10 years, let's say, and, the summary of payments overall. But what we can also do in this summary area is start to make changes to action items. These action items allow us to provide different hypothetical what if scenarios, like what if we're different, tax filing scenarios, or what if we plan to work for, private sector work versus public sector work, maybe counting toward public service loan forgiveness. And also, maybe we're considering switching our payment plan either to an income-driven repayment, or we can refinance that particular loan to maybe a lower interest rate, maybe a shorter term, to maybe pay that loan off faster. But the different strategies we may take with this student loan analysis is are pretty much laid out within this strategy tab. So there's a few different options based on what the client is potentially doing for work in the future. If they're working for a public service organization, they might have an option to potentially lower their payments with income-driven repayment plans and work towards, public service loan forgiveness. And they can, choose which different income-based repayment plan or income-driven repayment plan based on their individual scenario. So do they want to lower their payment if they're married filing separately with a payment cap, or do they want to lower their interest rate with no payment cap with repay, or do they want to just take a more general approach with income-based repayment? Or are they working for the private sector, maybe working to pay off that debt faster and refinancing to a private loan? Or do they want to lower their public monthly payments and again leverage one of those income-driven repayment plans with loan forgiveness? So based on what we choose within these action items, we're going to see a different option available. So maybe we see potentially an option to refinance this loan as a quick example, and we're going to see RightCapital is going to basically showcase what strategy this client is leveraging, and of course we can see the benefits of the different strategies that we have. And of course I decided to put that in for Bruce instead of Robin, who actually has the loan. So let's change that over really quickly here. So maybe again, just an example here of a lower interest rate, a shorter term, and we'd see a potential benefit to the client, right? Here's what your payments look like. Here's how they're different, and pay more but knock it out quicker. So those are kind of the simple illustrations, but let's talk about some more advanced breakdowns that we can talk through. So let's just say for a hypothetical situation that Robin is a medical school student evaluating whether she's going to work for a public service employer and attain loan forgiveness after 10 years, or is she going to work in the private sector and maybe get paid more upfront, but potentially see no loan forgiveness at the end of that 10-year term. So let's take a look at a strategy that we're going to create. And let's say that because we have Robin who wants to work for a public service organization, and maybe she's not really interested in lowering her payment, rather she's going to potentially just work towards an income-based repayment plan. We can actually set that up by saying that Robin is essentially a new borrower, let's say after July 1st. She is going to propose work to towards a public service organization and towards loan forgiveness. And instead of using the standard 10-year payment, she's going to use an income-based repayment plan. And so what I can do is, again, based on the strategies provided to me, she can either choose IBR or repay, and she's eligible for PSLF. I can then determine, what this looks like for Robin. So let's say maybe she's already been working, 12 months in that public service organization, and again, she's looking to work towards loan forgiveness with an IBR plan. As I hit refresh, we're going to see this shift for the student loan strategy, work towards public service loan forgiveness with an IBR repayment plan. And we'd also be able to see, potentially if there's, benefits with this scenario for Robin. So here I can see that, by lowering her payments with an income-based repayment plan, we're actually able to see, a total savings of $92,000. We can see the loan balance forgiven, and we can see all the nuances as it relates to the balances over time. We can see obviously, the balance stays a little higher with higher interest, payments being made, but then, at that 10-year mark, it just drops away. There's no taxation on the loan forgiveness, and that is going to incorporate all that data that we've provided. It's also going to show us the payments. So of course, we're paying less, we're paying more in interest, but overall, we can see the amount that's forgiven and we can see the total savings. Again, we might expect to see the total savings larger than the loan balance forgiveness, but we are of course seeing, additional interest being paid with the IBR plan because, we're lowering repayments, we're paying more in interest, but we're extending the term out to 20 years, let's say, instead of 10. So what's helpful here is all this information is going to adapt for us. But let's remember that data point that I mentioned on how important it is sometimes to include, some of these bits of information, like what the standard 10-year repayment amount is. And if I accidentally leave that standard 10-year repayment amount at 0, which is, remember, the payment cap for some of these income-driven repayment plans, we actually might see a slightly different scenario in our student loan tab. So as I visit the dashboard student loan module, we might see, that in fact, with the income-based repayment plan, we have a whole lot of savings, a lot of loan forgiveness, and maybe it looks like we're not making any payments with the current plan, and rather we just simply see the balance just completely forgiven after it grows with interest. And the reason that's happening, everyone, is because I did not input the standard 10-year repayment amount. And on top of that, since we're using income-based repayment, this payment amount is capped or limited to that standard 10-year payment. So that data field in the profile net worth becomes very important. And again, I know there's sometimes not a whole lot of data on the client statement that says this is your standard 10-year amount, even if you're using, let's say, an income-based repayment or an income-driven repayment plan. So that's where knowing how to access, the studentaid.gov, maybe, running a quick simulator with the balance, the interest rate, and a standard 10-year calculator just to see what the payments would look like can help input this value and provide some different planning opportunities for the client. So this is all really helpful. And again, we can choose to do everything from, refinance these loans, consolidate the loans, choose different income-based repayment plans, whether we're working married filing joint or married filing separately. And so there's lots of flexibility here to talk to the client about, what potential strategies that we might see. And obviously, we are working in a time where we have some pretty significant opportunities available to clients. So we know that through December 2022, there is a payment moratorium on federal loans. So clients don't technically need to make this $1,454 payment, through December 31st of 2022, and they'll have to start making payments on January 1st of 2023. So what the client might actually do is they can not make these 3 payments and actually see that additional value added onto the actual loan forgiveness. So we might actually see that in this case, there may very well be an additional $4,200 of loan forgiveness applied if the client takes advantage of the timeline where they're in that loan for that payment moratorium with federal loans. Because again, we've actually been able to document that this timeline, this payment moratorium is going to factor into public service loan forgiveness. So it'll just be simply, delaying making those payments, start them back in January, and then all this time where the client isn't paying those loans, that can be factored into public service loan forgiveness. And clients may not know that. They have to, they can elect to still make payments, but if they're working towards public service loan forgiveness, there really is no reason to, push that client to make any payments. Now, of course, public service loan forgiveness, as we know, has had some pretty big overhauls recently. We see everything from the new waiver program to help more people get that forgiveness applied. We also do know that the client needs to make 120 on-time monthly payments to qualify, and that time clock restarts after consolidation. So if we consolidate those loans, we're actually going to restart this timeline. And so instead of having 12 months factor in, we'd actually start from scratch, and we'd see probably less forgiveness. So just be aware of that overall as well. Now let's just In the last few minutes before we dive into all of your wonderful questions, take just a minute to mention that you can always make any notes around additional recommendations, not making payments through January of 2023. Just telling them the actual additional loan balance that may be forgiven based on that additional strategy. But let's take a moment to see where all this data factors into the actual software. So within the retirement analysis, we're going to have the option to, of course, have a current plan that uses the standard 10-year payment amount. And we also will have the option to toggle on the education or the student loan proposal to actually, simulate that new loan forgiveness strategy that we've seen. So under strategies, under the action items, we can add in the student loan strategy. This is an area where, of course, we can then see, for example, student loan strategy would pull all the data from the dashboard student loan module that we were just in, and it will apply it to the proposed plan that we're working on. So this would allow me to simply say, by toggling this on, all the data from that student loan proposal is going to be factored into this proposed plan. And one thing I want to mention to all of you, which is exactly what just happened here, is your specific settings may impact things like debt management and student loan proposals when you build them. Because in many cases, as a default, RightCapital uses a modified cash flow planning method, meaning excess income is simply spent off and ignored. Therefore, maybe the additional savings that we would have in the monthly payments or the loan forgiveness might add to the amount that's being spent off each year. So you can see maybe the current plan that has higher payments might just have a little less spent off each year. So we go from 61,000 being spent off to let's say 70,000 being spent off each year. That's because of the difference in the student loan payments. So in order to really see the impact of these changes in the pre-retirement years, it's going to be best to leverage a cash flow based planning method, which will allow us to more easily simulate a scenario that doesn't spend off that excess money, that allows us to kind of incorporate all that data. So again, maybe we're working with some hypothetical scenarios. Maybe these hypothetical scenarios we're looking at, might be, work towards public service loan forgiveness. And the second scenario might be, private sector work. So again, I'm just adding some new plans to get organized. And what we could do is actually use this, and this is a younger client. So again, the probability of success isn't quite as relevant. We're probably more looking at, comparing these as it relates to, I should say, assets at retirement potentially, as an example. But we could set this up so we have essentially, one plan, on the left, where the client's working towards public service loan forgiveness, and a plan on the right where the client is working towards private sector work. So here in the current plan, the client is making, a little more. They're not getting loan forgiveness. Versus the proposed plan on the left, we're going to actually dial back the income for the client and toggle on the student loan strategy. So again, I'm going to toggle on student loans. I'm going to dial back the income for Robin, and we'd be able to compare and contrast, what might be the best outcome for her, as she's just coming out of school. So maybe making a little less per year and taking advantage of the student loan proposal versus, the private sector plan, which is working, for more money, but not achieving loan forgiveness. And in this case, you can compare and contrast these options, and you can clearly see based on the situation for the individual client, you might be able to analyze, what is going to be best for this individual, with, assets at retirement, for example. So these types of scenarios really help us. But we want to remember that the income-based repayment plans also factor in the income. So by changing the income in the plan, we also will impact, for example, the student loan payments. So we can not only set up those case studies really easily in the retirement analysis, but just note that if you do toggle the income around, you will be impacting, in the current plan anyway, the actual, payment amounts and so on and so forth with these income-based repayments. So, again, RightCapital factors all this in behind the scenes, the discretionary income based on the client's residence state, the nuances of whether the loan forgiveness is taxable or not taxable, and ultimately, whether or not the client wants to work towards public service loan forgiveness or work towards private sector work and get paid more. These are great types of conversations to help clients understand what this might look like for them moving forward. Great. So some really great questions here. Clients have potentially a variety of loans, some with their in their name, some in their wife names, some maybe they're co-signing on as like maybe a Perkins Plus or a Parent Plus loan. Is the software capable of recommending a consolidation strategy and refinancing into an income-driven repayment plan? And the system will allow you to take multiple loans into consideration and consolidate them. And so we will, though, look for loans, essentially based on, their loan type. And essentially, we'll lay out, all the different loans the client has. We'll let you know the different eligibility for income-driven repayment plans. Again, whether they're eligible for PSLF or not. And some of those loans, like a Parent Plus loan, could be eligible, to be consolidated into, for example, like a Perkins Plus loan, or I should say consolidated to a direct federal loan to then leverage some of these other options. But there is consolidation options, but it is based on client co-client at the moment. So just keep that in mind. But if you have any feedback on this, we're always happy to take it in. I know that linking these loans, can be interesting when they come in. Maybe there's 10 or 15 loans listed out, right? We know sometimes they kind of take them out one at a time. But again, understanding opportunities for consolidation and even understanding opportunities for building these in with a private loan maybe that's being refinanced into a avalanche or snowball strategy for debt repayment could also be helpful overall. Perfect. Yeah. So understood about, there's some comments here about the interest freeze that's currently happening, and any tips on how clients can find the interest rates that will apply to them after the freeze. And so, at the moment, we don't have any specific recommendations outside of studentaid.gov to maybe provide some additional context. What I will say is one of the best things that they have here at studentaid.gov is a list of the loan servicers, which honestly is very helpful because it provides all the contact information for those different loan servicers. Mohican, Nelnet, Great Lakes, all those different loan servicers. They're all, going to be, good resources for the individual loans that your clients have. And again, there's different rules, there's different scenarios for each loan. So sometimes it can just be really helpful to have the client call in directly to their loan servicer and get some additional information as needed. But again, lots of good information here from the .gov student aid website if you need it. Additionally, I believe we also in the Help Center for student loans have a knowledge-based article that includes all the contact information here. So I know some of these are phasing out as of 2023. I believe Cornerstone is now being grouped in with Fed Loan. There's a couple adjustments, but for the most part, you can see all the information here and where to contact for the active loans that the clients have. So it could be a good opportunity for clients to maybe get a little more information to help you help them. Great, everyone. So, overall, this student loan module can be really helpful, but what's really important is that the data that goes in under the profile net worth is set up accordingly so that we can make the accurate recommendations on, what income-driven repayment plans are eligible for the clients, what strategies might they, potentially, proceed with moving forward, and the details, of course, the amortization schedules of any of the loans that we've built in. So, overall, we're here to give you these simple visuals. We're also here to tie these in with a more robust conversation around the full Monte Carlo analysis. But it is all going to be based on the client's residence state, their income, their existing loans, and of course, when they took those loans out. So if anyone has any questions, on how to set these different scenarios up, or how we can maybe add in or link multiple loans and do more consolidation there, you can always reach out to the Help Center, or you can reach out to our product support team Monday through Friday, 9 to 6 p.m. Eastern. As always, we love your feedback. Feel free to fill out the survey that comes after the webinar via email. Let us know if there's anything you'd want to see further. But we will certainly keep you posted as new updates come in for new income-driven repayment plans that are being discussed. As soon as the details are available, our engineers are going to get to work on building that into the software. But hopefully this has been helpful for a lot of you, and hopefully we've been able to answer some questions that you may have. Perfect. So one thing that just came in, I think is always helpful is, would you be able to review how you made the two different scenarios in the retirement module? So I apologize for going a little fast there, everyone. I will say that this retirement analysis tool is really designed for you to compare and contrast any scenarios that you encounter, whether it's a client paying, 100% down payment on a house versus 20%, or taking a lump sum pension versus an annual pension. And really here you can compare and contrast, any two scenarios. You can see, the differences as it relates to invested assets, assets at retirement, total taxes paid. So what I've done here is just simply migrated away from the general current proposed plan. And I've said that I wanted to build in, some new plans that I've named specifically, maybe work towards private sector work versus work towards public service loan forgiveness. And to just start, I build those plans out by clicking add or remove plans. I can then build in as many different proposals as I'd like. In this case, work towards public service loan forgiveness or private sector work. And I set this plan up so that the current plan is essentially the client working private sector. So maybe they're getting paid a little bit more, 150 or 200,000 just to start. And maybe, again, if we wanted to model these scenarios, the current plan is modeling standard repayment working towards basically private sector work. And as I create a new plan, I can actually just assume that this is going to adopt all the information, listed in the current plan inputs. So that's going to be helpful for me. So as I look to, private sector work, I can see that, they're just making the current payments as opposed to, the proposed plan that's using the student loan module. I again can, pull up, PSLF plan, where I was able to do two things here. I was able to change the income from 200,000 to 100,000, and I was also able to activate the student loan strategy. So again, simulating getting paid less in a not-for-profit hospital, and also activating public service loan forgiveness to show what that might look like over time. And so in that way, I have a proposal that's incorporating the changes of less income and working towards public service loan forgiveness, while I also have a current plan that illustrates the client just working private sector, utilizing the standard 10-year repayment. And with that, we can then again compare any of those changes. Just the tips here are, as you create new plans, they will basically default to using the current plan inputs until you use the action items at the bottom of the screen to adjust the data, like the salary or the student loan proposal, for the variable plan on the left. The action items always adjust the plan on the left, while the plan on the right remains our static plan that we can, compare against. So hopefully that helps to provide a little context there. But again, that just speaks to what we call multiple planning scenarios. And again, really, this is the area where you all can model any two side-by-side comparisons within the software with relative ease. So again, if you ever need assistance with that, or you want maybe a little walkthrough on that, don't ever hesitate to use the Help Center to contact us. There's this great contact us page where you can actually not only see there's live chat, a direct phone line, an email, but you can also schedule 15 or 30-minute calls with us using this link here. So lots of opportunity for you to work with us. If you're newer to us, you can always leverage your onboarding specialists as well. Perfect. So everyone, I really appreciate you spending time with us. As always, it's a pleasure to be here, and I look forward to seeing you next Friday for some more great content. I hope you have a wonderful weekend, and we'll see you next week. Thank you so much.